It's Monday the 7th of August, and today on Subject to Finance I'm going to try and tackle kind of a big subject, so wish me well. So there's two questions that we get asked a lot, and they're both kind of related. One is, what are interest rates going to do? And the other is, what are house prices going to do? And because we've been getting asked this question, particularly around interest rates, I'm going to try and break it down today. So my whole focus of today's podcast is, are we at the top or are we going to stay higher for longer in terms of interest rates? So in the last month, if you've been listening to my podcast, you'll notice that I've been optimistic that perhaps we're going to go back down again in terms of those rates coming back off. And then there's been other weeks where I've sort of mentioned that the banks are continuing to put rates up. And what we've seen over the month of July and even before that is that in any one week we can see one bank putting rates up and another taking them off. So it's really, really hard to know. It's sort of that thing of it bouncing along a little bit and banks taking margin where they need to take margin in terms of managing their own books. It's not really tied to anything that's going on with the OCR. And, you know, in fact, what we sort of heard from the Reserve Bank at that last announcement was that there was a sort of signal put out to the market that we've reached the top. But my question is, have we really reached the top? And I want to get into that a little bit today. So where are we at? Well, in terms of positives, there's quite a few of them. We've got very low unemployment. The results came out earlier last week around the last quarter in terms of unemployment, and that indicated that there hadn't really been any quarter-on-quarter change. So that unemployment rate's staying around the 3% mark where it's been, and it's not moving too much. We've seen high growth in wages, and wage growth is driven by a number of things. Over the last couple of years, it's been driven by movements upwards in terms of that lower end minimum wage, but it's also been driven by supply and demand. And with unemployment low, for people to get good people into roles, they're having to pay for them. And that's also been exacerbated by the fact that over the last couple of years, we haven't had a lot of inbound migration. Now that's starting to catch up now. But anyway, at the end of the day, unemployment remains low and the cost of labour has continued to go up. We've had strong fiscal support, so the government's been very supportive of protecting the economy through COVID, and that's continued. And we've also had fairly large infrastructural spend, and that pumps money into the economy as well. So something like the Central Rail Loop in CBD Auckland, that is employing a lot of people, it's employing a lot of services, it's buying a lot of goods and services from the local region, and all that creates positive flow on in terms of economic activity. Population growth isn't really stopping for New Zealand, so that continues to grow. The last 12 months we've had 75,000 new migrants, and that's not expected to slow down in the next little while. We've started to see a turnaround in the housing market with the valuation side of things starting to just notch up a little bit. CoreLogic have come out with some numbers around that in the last little while. And one big thing that we've started to see, which we haven't seen in a long time, is construction costs coming back a bit. So the cost to build coming back. On the negative side, we have high mortgage rates, which we're going to talk about more today. We've got a higher cost of living than we've had in the past. We've got lower house prices generally stopping people from listing, which is affecting you as agents. We've got a Reserve Bank that needs to throw the ice on the fire in terms of slowing things down, so that kind of works against us. So yeah, there's still negatives there. All the positive things that I talked about, they're inflationary, so they're all really creating the inflationary problem we've got. So actually what the Reserve Bank wants is to see more of those negatives, which is going to pull our inflation numbers back down. Now I want to talk about inflation a little bit in terms of imported inflation and domestic inflation, because they kind of get broken up into two by most economists. So imported inflation is what we had with COVID and lockdowns and bits and pieces, where our supply chain costs, the cost of the goods, the getting them to market, all that stuff went up. and that caused a global inflationary issue. Whereas our domestic inflation is more around those things that I just talked about before, like wages and our local cost of goods, so things like our vegetables, which got impacted by floods going up. All those things are domestic inflation. And what we've seen just recently is that imported inflation, the offshore or that global inflation, the supply chain inflation, the cost of getting offshore goods and exporting them into New Zealand or importing them into New Zealand, all those costs are coming back, and they're coming back relatively quickly. But what hasn't been coming back is that domestic inflation, which has been driven by the low unemployment and the high wage growth and other things. So at a government level, the thing that they're really struggling with is to get positives into our economy. They're having to spend, and when you spend, you create inflation. So yeah, if we look at what's holding up domestic inflation, you could say we haven't felt enough pain. All those positives are negatives when it comes to inflation. And, you know, we can't really win that inflationary war without a little bit more pain potentially. Now, the thing about that is that, you know, if we look at the interest rate piece, we go, are we at the top yet, or are we potentially going to stay higher for longer, or are we going to see those rates coming off? And so, you know, I've been looking at that and reflecting on what could drive the rates up further or what could bring them down. And I'm going to cover that a little bit now. So what's going to push rates up? Well, if government doesn't see unemployment going up, doesn't see some of the opposites such as house prices staying low, local costs of goods such as our grocery bill coming back, if the Reserve Bank's not seeing those things, then potentially it's going to leave the OCR higher for longer. Or it might even do a little bit of a shot above the bow of the boat to try and just push home the fact that we need to see more saving and less spending. Now, there's a lot of people that believe that running into the Christmas quarter, that potential for another 25 basis point rise in the OCR to slow things over that Christmas period in terms of spending is a possible. And the other thing that can keep those rates higher for longer is that offshore wholesale funding, which the banks also rely on, plays a big factor. So it's not just about the OCR, it's about where our big banks in New Zealand are borrowing from and at what costs they're borrowing. So some of their offshore wholesale cost of funding has gone up, and that could stay up for longer as well because globally there's pressure upwards. I mean, we've seen the US increase its prime rate in the last few weeks, and that prime rate will reflect on the cost of the funding for our local banks in New Zealand because they don't get all their money in terms of funding their book from just the domestic market. Some of it comes from offshore to make up for the difference between the loan book in terms of home loans and the domestic deposit book that they run. So offshore wholesale funding, if it remains higher, will mean definitely that we see the pressure on the banks here in terms of funding costs, and they're likely to remain higher here as well. So then on the other side, what's going to see those rates come down? Well, unfortunately, that's the negative side of the picture. So that is unemployment coming down, that's house prices coming down, that's all those anti-inflationary things, so the price of your grocery bill coming down, offshore domestic or imported inflation coming down. And there's very real signs that that could happen. I mean, one of the things that we've seen just recently is the position in China in terms of its economy. It's the second largest economy globally, and it's under pressure, high unemployment, particularly at the young end of the scale. They've had the property bubble that's burst, and that's created problems in terms of property prices. A lot of people wanting to get rid of property values dropping, very hard to get funding on property. There's been a lot of debt write-offs in the property space. All that stuff is deflationary. So at a global level, we may see that global inflation start to flow through in a greater way too. You know, if China needs to increase its outputs, then it's probably going to lower some of those internal costs around wages and bits and pieces to do it, because it needs to largely export its product, although it's got a huge domestic economy. some of that value will come our way. So that will be deflationary. Our household debt in New Zealand, it's really important, and I think I've mentioned this before on one of these videos, it's important to understand that only 38% of households in New Zealand actually have a home loan. So there's been a lot of talk from people over the last few months saying that we're going to see a huge impact on rates going up, but not everyone has a home loan, and a lot of people are still doing actually pretty well and are still spending. So yeah, it's just household debt going up should put the handbrake on spending, and that should slow down the economy and create a deflationary thing. But it's not that every household has a home loan, and even if they do, what the size of that home loan is can make a difference in terms of their impact on spending and other things. We potentially will still see some pressure on households, and that may result in some mortgagee sales or increases in mortgagee sales, but really it's not going to be a widespread thing from what we can see. We always look at long-term swap rates, and I've definitely mentioned those before as a measure. Actually, at the moment they've sort of flattened off, so there's not much going on with swap rates across the 1 to 5 years. At the moment they're looking fairly flat. So yeah, if I look at it from where we're standing at the moment, it looks to me like we're probably leaning towards the higher for longer, but in the long term still good indications of rates coming back. And globally there is a lot of deflationary pressures in terms of things like populations reaching max in terms of max numbers in places like China, Europe, North America. When you've got a declining population, keeping those sort of inflationary rates up that you've had traditionally is very hard. We look at China, where it had a massive run from the early 80s through to just recently in terms of double-digit sort of growth. I think in early 2000s, China might have sort of been in the 15% range in terms of annual growth. Well, you can't carry on doing that if you haven't got that sort of growth engine in terms of population sitting behind it. So while they still showing relatively good growth, I think they're at sort of 6% per annum, which is, still sort of deemed inflationary environment. They are cooling, and they're cooling pretty quickly. So, I think that potential for those big markets like China and Europe to continue to cool will have an effect globally. The other thing is things like oil cooling as there's pressure on carbon and the reduction in use of fossil fuels and bits and pieces. All that sort of stuff does generally point to some global reduction in that inflationary thing. So, yeah, I kind of look at it as we stand at the moment and go, domestic inflation is what's holding our rates high. We don't expect to see too much change there. I think all the things that we want are going to keep it relatively high for longer. We want those house prices to stabilise or to start moving up. We don't want employment going down. We want to see some of the export trends and bits and pieces picking up. We want to see tourism picking up. All those sorts of things are likely to hold that inflationary price up for longer. Whether or not some of the relief we're seeing in terms of that imported inflation from offshore gets passed on by retailers and things over time is hard to know. It's sort of seems to me as more unlikely. But if it does, then that will counteract some of that inflationary pressure and potentially ease things. So my view at the moment is that it'll take longer for that to happen, and therefore that we'll see those rates stay higher for longer in terms of the banks. But over the next year or two, we'll start to see that sort of stabilising come off, and longer term we could be back to very low rates at some point in the next 5 years. So that's where I sort of see it sitting at the moment. I hope that helps in terms of explaining it. I'm not an economist and I don't have a crystal ball, so I certainly don't deem this as advice. It's just how we sort of see the market at the moment. And I think when it comes to what that means, if I'm talking to borrowers, it's probably more likely that you'll want to think about having a bit more of a plan of attack around interest rates that is based on those rates staying higher for longer. So you might want to split those rates that you're putting in place as borrowers into
different camps, so some into 1 year, some into 3 year, or you might want to go 1, 2 and 3 years, or if you just really want stability for the next 5 years and you don't want the risk of it going up because that would put pressure on you as a household, then you might want to even have some out into that 5-year range. So those are the conversations that you need to be having with home loan advice givers such as mortgage brokers, and just thinking about hedging your bets a little bit more than just plugging it all onto that 1 year rate. Hope that helps. Have a great week ahead, and no other major news in the market this week, so it's really just been a good chance for me to focus on one thing, and I'm going to touch on house prices next week, so look forward to talking to you then.